Thanks, and hello. So, half-year results to the 30th of June, and the big highlights there are higher sales, higher margins, lower costs, which translates in the numbers to significantly reduced operating losses, significantly reduced underlying cash consumption, and significantly reduced actual cash consumption. But beyond that, I think it's been quite an important half for us as we started to change the business model from being a single technology business to a multi-technology business. So while that has no impact at all on the sales in the first half and probably very little on the second half, I think going forward we'll start to see a different proposition there, which I think is very important. I think it's an attractive one for our customers. So esophageal Doppler I think it's a brilliant technology. It uses low frequency ultrasound through a probe which is placed in the esophagus through the mouth and nose, and it bounces the ultrasound off red blood cells as they travel down the aorta straight after they're pumped out of the heart by the heart. And what we're doing there is measuring the very fine instrument, measuring very precisely the velocity of those red blood cells. Then on the right of the slide, as you see, where we plot those on what's called a velocity time integral. So every 180th of a second, any blood flow going past the point of the probe is plotted on there, and you get this characteristic waveform which builds up. So clever technology. So what it enables the doctors to do is to manage patients at times of stress under anaesthetic or intensive care, and use primarily fluids but also some pretty aggressive drugs to make sure that the circulation is working, and its purpose is to deliver oxygen to the tissues. If they keep the oxygen going round through the blood supply to the tissues, the organs avoid damage. What we see that coming through in the evidence base built up over 20 plus years is that using esophageal Doppler monitor during surgery halves or slightly more than halves complications after surgery. Now that's important in the short term. Complications are nasty. They also cost health systems a lot of money, but it's also important in the long run because having a post-operative complication after major surgery on average reduces your life expectancy by 7 years. Which is a lot of years and very nasty. So there's a big fundamental shift possible in the safety of surgery and patients' ability to survive it. Moving on to the numbers, the results highlights is revenues up 7% to just under 3 million in the first half, and by way of explanation, the second half is traditionally stronger by quite a bit because of the way our distributor sales patterns work. So that's good. That's the first time we've had growth in the first half since 2014. For those who followed the story, that's because we've had a lot of difficulty with the UK market, even though it remains UK government policy to roll out esophageal Doppler monitoring fully at pace and scale. Their attempts to implement that has actually meant it being used on fewer rather than more patients. But there we are. All the growth in the last few years has been coming from exports. The export growth is enough now that it's seen the whole thing back into growth. We saw that in the second half of last year, carried on into the first half of this year, and sees the company back on a good track with opportunities to increase the growth rate coming through in lots of places. Gross margin up from 64% to 76%. And if you look in on the consumables, which is the core of our business, that's up from 70% to 80%. So we managed to increase significantly what's already a very high gross margin. How did we do that? We did that by bringing the key manufacturing process for our disposable single patient probes in-house and changing that process to streamline it. So very significant and sustainable going forward. Operating cash costs reduced by £300,000. We've been trying to keep our costs under control for a long time. We're very good at it. We're just nudging and tweaking away at those. We would expect that to come through again in the second half. And that obviously makes a big difference, the second half cash flow. So with the improved margin, worth a couple of £100,000, with a cash cost worth £300,000, it's worth pointing out in the second half last year, the underlying cash consumption was only £400,000. So even without any sales growth, we would hope, extrapolating forward, we'll be in a good shape going through the second half. So cash operating loss was down over half to 0.6 million. Net cash, operating cash actual consumption was down 1.1 million to 0.4 million. So that's a very significant step towards getting that number down to zero and then into positive territory. At the end of the half, we had about £200,000 in the bank, and we topped that up with another £500,000 net raised in July. Sales-wise, the growth driver came from the States, where probe revenues were up 20%, that's £200,000, and total revenues up another 100,000, 0.3 up, which is 35% growth, which is in line with our trend since 2014, when we started investing more heavily in the States. Local currency terms, 20%, not quite as strong. The US market in general for healthcare has been a bit soft for the last probably really 12 months. Uncertainties about the presidential election, uncertainties about the impact of the result of the presidential election, followed by uncertainties about what's going to happen to repeal or supposed repeal of Obamacare, which actually I don't think will have any effect on our business whatsoever. And now you've got the problems in Korea. So it's all just been a bit soft and slow, but we continue to go forward. We're going forward in lots of our accounts, and we're adding on new accounts as we go forward. So that's all promising and all broadly on track. Internationally, most of our international sales are through distributors. Some of them, such as France, which is still by volume our largest export market, so it's the second largest market by volume after the UK, and it's still more probes sold there than in the States. That continues to grow, so Europe went quite well. We've got some of the further fung distributors, particularly Peru and Korea, where we've seen changes in ordering patterns. So both Peru and Korea ordered probes in the first half in 2016, only Korea ordered and fewer in the first half of 2017, and there were no monitor sales to either of them this year. So that meant the overall reported numbers down, while actually all our distributors, or all the important ones, are reporting satisfactory progress with end user sales. Within that, I think Korea seems to be going particularly well following reimbursement being given in the first quarter of this year. So we'll give it a bit more time to make sure those trends are real, but that's above trend growth coming out of Korea, which is good. Then the UK, which has been very difficult for us, partly with some specific local reasons with this NHS attempt to roll out our products, but also the NHS is in severe financial difficulties and is trying very hard not to spend any money at all on any equipment, even though lots of people sort of understand that if they did do that, they would save a fortune. But anyway, that was better than it has been. So overall revenues were down 3%, about £35,000 and £1 million. This time last year, they've been down over £430,000. So we put the brakes on, slowed down the rot, and that stopped the whole group sort of being focused on the UK deterioration. We're seeing the export growth putting the whole thing back to growth. Put that in context, 2013, over 70% of our revenues came from the UK with the esophageal Doppler. The first half of this year, it was under 30%. Operationally, as I said, the US sales development plans are on track. We've done a bit of a change around in the first half, where we've taken some staff out of some areas where we've opened fewer accounts and rehired in other areas where we've got better prospects and more accounts to service. So that process should be finished by certainly the end of October, which will give us good traction at the end of this year going into next year. And we keep on growing the pipeline, and some of the ones which I hope to come through very shortly are top-notch accounts, top 10, top 20 hospitals by any reckoning in the States. Those are important because they're the ones that people will follow. Margin improvement I've already mentioned, but that's significant, that's bedded in, and that's permanent. There's still some tweaks and nudges to go on that, which is helpful. We had 2 new products in the first half. The first one is really a parallel thing, a veterinary system, which is broadly the same as the human one, but with slightly different algorithms and a slightly different probe. We introduced that in the first half. We're actually launching it this week at a big veterinary anesthesia conference in Nashville, Tennessee. And the feedback's been very positive so far. And what we're really trying to do over the next year or two is establish the need in veterinary medicine and then look to find a global distribution partner to go and exploit the opportunity. More significantly for the long-term future of the business, on our core platform, the CardioQ ODM monitor, we added in a new technology called high definition impedance cardiography. Entirely non-invasive, and it means you can use it on awake patients, so it kind of goes where the esophageal Doppler doesn't go. There is very little overlap in where they would be the best solution, but adding them together with the third technology we've already got in our box, pulse pressure waveform analysis, means we now have a solution which covers every patient in the hospital, and that's from the infant to the very old, and you can use it from the clinic all the way through to the patient who's in a coma or in intensive care. So that's a big change for the business, and I think they'll see more of that and news on that coming through in the next 6 to 12 months as we start to work out just how hospitals want to go and adopt that. Export launch for the high definition pediography, we're aiming to get it out by the end of this month, early next month, once we complete our initial stocking orders. To date, we've only had it in the UK, but we've already pre-launched, I suppose, into some of our international markets to the distributors, and the interest is strong. And then, as well as having this platform idea coming together, we do have some additional bells and whistles to add in, which are in the pipeline. But the fundamental is done in the first half of this year, so that's what we're going to build on. Cash performance has got a couple of charts. The first one, this one is underlying operating cash consumption. I split it by first half and second half. So you can see that when 2014, when we raised quite a lot of capital to change around our operations, to do the margin improvement, to invest in new products, but also to go and build a proper sales presence in the States. You can see the spikes in both the first half profile and the second half, and you can also see those reducing as we come down the other side of that investment mountain. So that's looking very positive. Obviously, we don't know what the second half cash consumption, operating loss, or whatever it will be yet, but if it's the same sort of improvement we made in the first half over where we were last year, and that would move that into positive territory. So that's very much our intention and plan and what we're focusing on trying to achieve. In terms of actual cash consumption, that's split between the net operating cash consumption and the money we spent on investment, primarily product development. And in the green bar is the total. Again, you can see sharp reduction in the first half, and then in the second half, which continually consumes a bit less, you see continuous improvement, which we expect to continue. In the States, I think it's just worth highlighting because 20% growth is okay in underlying currency, but we're looking for really, I think, 35% or more as our underlying rate, and that's what we have been achieving. If we look into that, we look at the six sales territories we split our current operations down into, and you see the two where I think you've got the sales team is genuinely on a roll, which is important in this business, because when you've got a pipeline and things going well, you can see extra accounts coming through, growth in the existing accounts. You can typically roll forward 2 or even 3 years and see continuing growth over that sort of period. So getting on a sales team on a roll is, for me, one of our key sort of soft metrics. Mid-Atlantic was on a roll over a year ago, and you see that coming through. They grew strongly last year, they're growing strongly this year, and they've got a couple of the best pending accounts to add on to that, so that's exciting. In the Great Lakes, sort of Chicago, Detroit, into Ohio, that, I think, end of the first quarter, that sort of got itself onto a roll. You can see that coming through, and again, the prospects look very good. There were some monitor sales in the first quarter to boost that, but you can see that coming through now with increased probe sales every month from where we put the monitors in. So that's looking positive. The other territories, we're in there growing, 5 to 10%, which is a bit pedestrian. 2 of them are held back, so they've got very old, well-established, large accounts, so you wouldn't expect them to grow quite as fast. So also those are territories where we've been changing the staff around and the profile of the staff, so that does cause a bit of a drag. But it does mean they're both sitting there in quite good shape and continuing to progress. And the Northeast, I think, is probably the next one I would call to be on a roll. We've got a newer team and mostly newer business, but we're starting to see some good accounts getting some bit of traction and regular usage, so that will come through in the numbers going forward, we hope. And then Northwest and the Southwest is where, through the staffing challenges, and not necessarily of our own making, we have not really been able to do the work we wanted to do, and that's dragged the overall growth rate back a bit. But we've got a new team in place, or should be in place going into Q4, and we'd expect that to make a difference quite quickly. Looking forward, US expansion program, we're looking for news on that, traction in the existing accounts, and we've got some interesting things happening in certainly some of our highest quality accounts. Adding new accounts, we've got those coming through the pipeline, and then we're doing some other work to try and cross-sell in systems, which sounds easy on paper, but none of the systems really know how to spread best practice. So we're at the cutting edge of that, and I think if we can get that right and some systems doing that, that'll be great for the numbers and the progress. And we're also then working on some specific niches where esophageal Doppler, our core product, really does shine. Why do you want to do that? One, because it's good for the patients, it's good for the business, but also because as you move to these sort of hemodynamic workstation platforms, I think what we're looking for is people want to buy the Deltex one because it's got the esophageal Doppler, and at the moment that'll be the only one with the esophageal Doppler on it. So that's an important point just to make. New product development, as I said, we've got the platform together. We are selling 3 technologies on a single platform. That does mean we can go from the young to the very old, from the trainee nurse through to the world-leading expert who's published 50 papers. We've got something on our platform now for everyone, and you can use it from the awake patient in the clinic all the way through to the intensive care. Rolling forward, I think that is important because it gives us the opportunity to go and be the sole supplier to a hospital of all their hemodynamic monitoring needs across the whole hospital. That's a very important thing. I think that sort of moves you into a product which is a big company product rather than the small company trying to establish a new modality. Velocity pressure loop displays, it's got a couple of slides on that. We're working with the Lavoisier Hospital, the University Hospital in Paris, for the last 3 or 4 years on this. What we're doing here is you're plotting pure inputs from our signal based on the speed that blood flow is travelling, effectively the highest speed it gets to in any individual cardiac cycle, and then the length of the flow time, or what goes on to here. And then you've also got the peak systolic and diastolic blood pressure. So that's when the heart's pumping and when it's filling. And you see there, if you look at loop B, is pretty normal. That patient's got quite enough pressure and quite a bit of flow, and as they stay in that state during a major operation, they're unlikely to get a complication which is hemodynamically related. But both A or C are very high risk of getting a complication which is hemodynamically related. A at the bottom, as you can see the shape there, it's thin and flat. That patient has got insufficient blood pressure. Flow looks okay, but actually the blood pressure there is not enough. They're into hypertension. That's associated with pretty poor outcomes, lots of kidney injury, but also heart attack. And there's big data studies coming out of the States suggesting that about 1 patient in 100 dies post-operatively because they've gone into a hypertensive state during surgery. Up at the top, loop C, that's a patient there who's short of fluid. And again, hypervolemia, shortage of fluid, is associated with very bad outcomes. Both that and hypertension. Small periods in there are bad for you. So what we're trying to do is provide displays which allow the doctors to keep the patient in a good zone and deal with them going into a bad zone very quickly. One case example behind that, and this does come from Paris. And this, you can see the before loop is the long thin one. That's a hypertensive patient who is at risk of various problems with that. Pressure's too low. Absolute universal response. I think you get great consensus. When the pressure's too low, what you do is you do things to make the pressure higher to correct that. This case, they use a drug called phenylephrine. It's a vasopressor. So it's designed to tighten up the vascular system. If you tighten up the vascular system, blood pressure goes up. What you can see here very graphically, though, is while they've sorted out the blood pressure, you've seen the blood flow has been compromised. So you've gone out of the frying pan of hypertension into the fire of hypervolemia. So that's something which, without the esophageal Doppler, now this easier use display, simply isn't apparent. And certainly some of the technology we sell, pulse pressure waveform analysis, which is a nice, easy to use technology, and it's probably the most commonly used one in this sort of field. That would tell you, because the pressure's gone up, that the flow's gone up. So the doctor would think he'd done the right thing and not put the patient at risk. The Doppler with the extra insight says, actually, yes, you sorted the pressure, but you've compromised the flow. So that gives us a very strong thing to take forward as we go, as we move on. So, summary, sales back into growth, driven by the States, but also we've got traction in the underlying traction in international markets. So we'd hope to see that coming through in the second half. The UK is more stable than it has been, but remains a very difficult place to sell any sort of technology. And I mean, we don't hold huge optimism for the next few years in the UK, but it's now a smaller part of our business, so we can see the growth by putting into our focus markets. Margins have improved, and a bit more to come on that. Costs are reduced, cash operating losses and consumption are significantly down. We've made quite a lot of investment in the last few years in new products, which is substantially complete now, and we're starting to see those products coming through, and you'd hope to see incremental growth coming through from those. And then I think crucially from the strategic point of view, we've now got the multimodal platform in place with the little bells and whistles to add on to that. But we have that offer now we can take to the whole hospital. I think that gives us in a strong position looking forward. That's the presentation. Thank you very much.
Thank you very much, Ewan. Very comprehensive. Right, we have a number of questions already. I would like to remind listeners that you can input them via the icon on the top right of your screen. Let's dive straight back into America. Ewan, clearly an important market for you. Could you give a little more explanation about the regional variation that you are seeing in terms of penetration? Is it a people thing? Is it as simple as changing your sales force, or is it changing the personnel who are in charge of ordering your products? And could you've opined about upping the growth rate. How quickly would you expect the new sales teams in the Northwest and the Southwest to repair momentum?
Well, it's very difficult to change the staff in our customers, so we have to focus on what we can control. So where we get good people, and that's a mix of sales skills and then the clinical trainers or the clinical support specialists who work day to day at the bedside in the accounts. Where we get people who are up to speed, doing the right things, following the right model and moving forward, it takes probably about 18 months to get into a sustainable growth pattern. But once you're in there, as long as the pipeline's in place, as I said, that can pursue, that gives you, you can look forward 2, 3, even 4 years, and you can see that growth continuing. So that's what we're trying to do. So I think that the ones which perform better this year are ones who are on a roll. It's where we've got people who've been in place, who are working the way we want to, who have the customers working as they wish. They probably built 2 or 3 local opinion leaders who help them go and spread the word into other hospitals or across the hospital, across the individual hospital. That's the sort of model. Other ones, it is more difficult. But I think it takes about 18 months if you put someone into a virgin territory before they would have a real regular stable business, and it'll be between 18 to 24, maybe even 30 months if you're adding a couple of heads in as you do that before they'll be generating cash. But once you're into that cash generation, it's actually quite difficult to go backwards. So that's the sort of model we're looking for as we go forwards.
Thank you very much. Competition in America. Obviously, Edwards are a £600 gorilla, but it's been noticeable that new entrants, well, not new entrants, but people turning their attention to non-invasive like Cheetah have just raised quite a substantial amount of money. Do you regard that as a threat, or do you think that illustrates the scale of the opportunity that people are waking up to?
Well, Cheetah just announced this week they raised $12 million or $11.7 million. Now, part of me is obviously jealous of that. I mean, that's about $11.6 million more to spend on marketing than we've got at the moment. We just got to do what we're generating from our own resources. However, I think it does validate that is the market. That's where I think the whole industry sees. That's where the opportunity is. Edwards have put a lot of money into that market in the US over the last 3 or 4 years. They've essentially taken what was our strategy, copied it, and are doing it with far more resources. Edwards are always seen as good competition at this stage. They are creating the market. They are pushing the enhanced recovery message, the importance of intraoperative fluid management. So the more that goes into that, the more you sort of, this rising tide floats all boats. With Edwards, it's interesting as we see a few accounts where we're working in quite nicely now, is where they've got started with Edwards, and they still use Edwards, and Edwards do a nice job supporting it, but then as they get up to the higher risk situations, they need a better, a go-to technology. This creates an opportunity for us to come in. So that's fine. I think the other player in the market is Lidco, another British company. Back end of last year, they raised £3 or £4 million specifically to invest in growing a US sales team. So again, a couple of years behind us, so they're going to be climbing up the mountain for the next year or two, whereas we're coming down the other side. I think it all validates that everyone's worked that the States is the place to be. The market's coming together, and that's plenty of room for everyone at the moment. But that's where you've got to build a position if you want to be a player going forward in the long run.
Okay, and staying on the export theme, could you just elaborate on the currency moves and how the recent weakness of the pound might be an opportunity for you, looking more at European markets. But of course, at the moment, we have a situation where even the dollar is weaker than the pound. And could you explain a little bit about how that might affect your pricing comparisons as you've got more of production in-house?
But the dollar is good for the revenue line because you just translate our dollar sales. But actually, we are a dollar business in the States, and since the Brexit vote, June the 23rd, 2016, when the pound fell sharply against the dollar, that's great news for the top line. But actually, underneath of the bottom line, that's been bad news for us because we've been spending more dollars than we've been earning. So that's probably cost us about £300,000 out of our cash reserve. Just to cope with that. Moving forward, as we start to generate our own dollars, if the dollar's strong against the pound, it translates into more pounds. If it's weak, it doesn't. I'm not hugely fussed. We've got broadly moving towards a natural hedge in there. I would expect us to be reinvesting surpluses in the States for quite a long time to come. It's a very big country. We've got a reasonable infrastructure. We can grow that. Euro has been quite nice for us in the last period because we don't have that many euro costs. However, the HDICG, the high definition impedance cardiography supplier, is a French-based company, so we're actually moving more towards upping our costs in euros. So again, I think you'd start to see a hedge, and ultimately having a nice hedge in your currencies is really where you want to be.
Sounds very sensible. Obviously, the US is a major opportunity at the moment. We have a question about whether you have on your long-term radar any plans around China.
On our long-term radar, yes. China is it's a huge economy. It's whatever is a sixth of the world's population, and where there's people, there are hospitals, and where there are hospitals, there are opportunities to sell our kit. It is a complex, it's a difficult market, and it depends who you listen to. Actually, at the moment, I think with a capital type of sales model, it's probably more attractive than it is with our model, which is based around repeat users and consumables, dealing with it, the regulatory pathways, how the hospitals work, some of the things that you need local presence. So it's an expensive investment at the moment. It is not high on our list. We do keep it under the watch. Japan's the same. I think once the business is generating cash, we would look to establish a presence in both those markets, but almost definitely through distributors and in a low cost, fairly low risk way to achieve that.
Okay. And then just wrapping up with a couple of questions closer to home. Given the strong medical reasons and background for supporting ODM, do you still have hope within your heart that the NHS ordering roadblock will eventually allow you to get recognition and suitable sales?
Well, I'd hope so. I mean, it is to my mind, I am a bit biased, but it is backed up by very robust evidence and a decision from the National Institute of Health and Clinical Excellence going back 4 or 5 years ago, which they just reviewed and confirmed earlier on this year. There's £1 billion to be saved, but more importantly, there are 20,000 patients probably dying unnecessarily after surgery in the UK, and I think that's wrong, and I think when they've got means to avoid that, it should be avoided. The fact that it can be dealt with and save money and make more resources available for other things, to me, has always made it a no-brainer. I suspect we will get there in the end, but I don't really think that Deltex would be minded at the moment to put too much of its energy and creativity to making that happen. I think we're better off going places who are more obviously interested, and we can see the returns coming through more quickly.
Right, and then lastly, could you just comment a little bit about your current register? To the external eye, it appears that the top-up funding that you've taken on this year has come more from an individual or a high net worth source. But do you find that main UK institutions are still keeping a close eye on your progress?
Well, I think the institutions who are invested in us are keeping an eye on them. I think they can all see that we are turning that cash corner. I think they can see that, which is, when you're a growth company, you want to have growth. So getting back into growth after the problems we've had in the UK is a big step forward. I think the reception is there. I do think at the moment this is a good stock, and it's a risk stock, but it's a good stock for the high net worth individual, the sophisticated private investor, because it's got the potential for returns. Lidco, again, our nearest comparator, market cap's about 3 times ours. We got similar levels of sales, but we grew slightly quicker overall. We grew faster in the States, which is the key market, and our cash consumption has now come down below theirs, while those is going up as they go through the investment bit. That's not to say they're not. That's not meant to be snagging them off at all. I mean, I think they're doing the right things. I think that as we look at them compared to them, we are undervalued at the moment, and ought to be an attractive investment opportunity.
Well, that seems a very suitable note on which to finish. Thank you very much, Ewan, and we wish you all the best for your second half, and hope that seasonal bias comes through.
Thanks very much.
And thank you to our audience.